Hey everyone, this is Dave Keller with StockCharts.com. I wanted to look at the bear market through the asset allocation lens. So we think a lot about stocks and the sell-off that they've been in, but how does that sell-off relate to other asset classes? We're going to go through what I would consider the asset allocation decision, looking at stocks versus bonds versus commodities versus currencies, and then very quickly look through each of them individually for some of the key themes I think we need to pay attention to. I gave a presentation to an event locally here in Seattle in mid-February, and I noticed that all of these asset classes were going up at the same time. And that second week in February, is sort of everything's in a bull market. And the comment I made was that that's certainly unsustainable, right? You cannot keep that pattern. Something has to give. And we saw in the second half of February what did start to give. We had stocks obviously selling off very quickly. Crude oil sold off aggressively. The dollar started to weaken. Even gold pulled back. And bonds were the only thing that rallied, and they rallied hard into the first week in March. Since then, though, things have stabilized a little bit. Crude oil continues to be in a significant downtrend. Stocks, I would argue, even with a bounce here early in the week, continuing to be in a downtrend of lower highs and lower lows. I think that's undeniable. So the question is, how does that relate to some of the other asset classes? I think it's worth noting here, I think maybe the main takeaway is don't get too caught up in what should happen. A lot of times people say stocks are selling off, so gold as a safe haven should do well. There are plenty of times when that has happened. However, what we've seen in the last couple of weeks is stocks and gold have actually been selling off in tandem. They've been moving together. So don't think as much about what should happen. Look at what actually is happening. And with that in mind, let's look at each of these very quickly and just pay attention to some of the patterns. When I'm looking at the US dollar index, overall, this is something that had been in a slow and steady uptrend before really coming off at the mid-February to mid-March. Since then, it's been in full-on rally mode, and even there have been days where the dollar has weakened. Overall, the trend has remained significantly strong. I think that's what will continue to mean U.S. stocks over non-U.S. stocks. I also think in general, you would think that would be more supportive of small cap stocks, but I think with the whole coronavirus pandemic and how the economy is adjusting to that, I don't think that's as much of a theme, but it certainly speaks to the strength of U.S. Versus non-U.S. Looking next at bonds, the way I usually look at this is with the TLT, and bonds had rallied strongly into the second week in March, and then since then actually pulled back very aggressively right to the 200-day moving average. I think what's interesting with the chart of the TLT is it found support right at the 200-day, trade below it intraday a couple days ago, and then returned back to close back above the 50-day for the next couple days. But it also came right back down to that sort of region of stability from the fourth quarter of last year. That certainly is seeming to be a key support level for bonds. Since then, even with increased volatility, which most assets I think have seen, certainly bond prices seem to be going higher. I would caution a lot of people I know see interest rates near all-time lows. They think, well, how much higher could bonds go? The answer is they can go much further than you think, and interest rates can keep going lower more than you probably think is reasonable. That takes us to two more, oil and gold. With oil, when I'm looking at a market like this, when something's in a falling knife scenario, which I think oil is, you're going to see huge percentage swings because the price is so low. However, I would remind you to take a step back and just look at the peaks and the valleys and look at the trend. I'm seeing oil in a downtrend. I'm not seeing the stability that I would expect to see if we're going to get some sort of lasting rally. So overall, oil, I think, seems relatively muted for the near future. That leaves us with our final chart, which is gold. And out of all the assets that I just mentioned you, maybe with the exception of the US dollar, I think gold is set up probably most keenly to appreciate from here. It's gapped up pretty well in the last couple of days, with reacting, I think, to further sell-off in stocks. But overall, it's setting up beautifully. It pulled back to the same support level it found from last November and December. This was just when it broke below the 200-day, but that was a false breakdown. It rallied back above and now is once again approaching previous highs. All of that is interesting, but the relative strength is what tells you the real story. If you want to outperform the S&P 500, you need to own assets that are improving in relative strength, and that's where gold certainly is. That leaves us with the S&P 500. And again, what concerns me overall about stocks is I think the breadth characteristics now are more similar to what we saw the fourth quarter of 2008 as opposed to the first quarter of 2009. And the short answer is, I think that means further weakness for stocks and further increases in some of these other asset classes. That's my take on a bull market during a period of instability using asset allocation. I'm Dave Keller from StockCharts. Be safe. Thanks so much.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.